All right, well, you just heard from Loretta Messer there, Cleveland Federal Reserve President. Some headlines here from that interview saying that, once again, reiterating that inflation is too high. Growth she expects to slow here for the remainder of the year, stay below trend. Also making some comments about the banking system as well, saying that the banking system is strong, that it is resilient. Still some questions, though, about credit conditions tightening. So we want to bring in Nancy Tengler, Laffer at Tengler here, joining us for the conversation. And Nancy, let me start with you right now, because starting with some of those inflation comments, growth here she expects to slow, but she did reiterate that the Fed has a job to do, and that is getting inflation under control. What did you make of her comments and what you think the Fed should do next?
Yeah, so I think we should note that Seana, that she doesn't vote in this next round. But importantly, the Fed let inflation turn in from a controlled burn into a wildfire. They went almost a year without raising rates after we knew inflation was rising and still expanding the balance sheet. If you go back and look historically, if you look at previous inflationary periods, what you see is that inflation is mostly symmetrical on the way up and on the way down. And so it took 16 months to get to peak inflation in June, and we're now 12 months or 10 months into the decline. I actually think we're seeing progress. And the Fed is, when they started to go data dependent, looking at backward data, that's when they began to make the mistakes. And that was at the meeting in 2020 at Jackson Hole. But if you look at the leading indicators, leading economic indicators are down significantly for almost 12 months. The PMIs manufacturing have rolled over much more dramatically here than the rest of the world. Employment's coming down. We wrote a piece in February that said average hourly earnings, employment cost index, and the unit labor costs had all rolled over, and that belied what we were seeing in the non-farm payroll numbers. Remember, that January number was huge. So when you start to look forward, what you see is that the Fed has finally started to make progress, and I fear that they're going to go too far because they're looking backward. Last thing, CPI is almost 57% of it is shelter, and the real-time shelter numbers have rolled over. So the Zillow index and the Penn State index have rolled over pretty materially, saying that inflation is coming down. It just hasn't shown up in the numbers yet because of the lagged effects of how they look at shelter.
And that is difficult. The numbers they're looking at, certainly a lagging effect. So also with us, Sonia Meskin, BNY Mellon Investment Management, head of U.S. Macro. Nice to see you. Your thoughts
Hi, great to see you.
On what we just discussed there. Do you have that same fear that though they are seeing progress, that perhaps the Fed will go too far?
Well, I think there's a lot of uncertainty in the markets right now. And one of the big reasons why that is the case is because economic data is not unequivocal. There's some data that's pointing to continued strength. We just saw the Empire State Manufacturing Index earlier this week. Look at the Philly Fed, other than the headline business conditions, business sentiment index, the underlying numbers were quite a bit stronger. You look at the Atlanta Fed wages or the ECI, wages have actually accelerated again. But then you look at average hourly earnings, and yes, they have moderated. And you look at some of the indicators that you guys just pointed out, and yes, there is some moderation as well. So I do think that there's a greater uncertainty in the data than is typical, and I do think that introduces a continued uncertainty for investors as well, and for the Fed.
And speaking of some of that uncertainty, President Messer did weigh in on the banking crisis, what we saw play out in the regionals over the last several weeks. Let's play a quick clip of what she had to say about that.
Now, even before the stresses in the banking industry in March, banks were already beginning to tighten their credit standards. And that's because interest rates have moved up. But that's the typical way that monetary policy transmits into the broader economy. So the question now going forward is, will stresses in the banking industry, those stresses in March, lead banks to move faster to tighten their credit standards? And if so, credit will become less available. And that has the same kind of impact on the economy as tightening of monetary policy.
Nancy, are you seeing any signs of a credit crunch at this point?
No. I think if you talk to the banks, PNC came out and said that they were not cutting back on lending. We saw the same comments from American Express that consumers resilient and they're increasing their loan loss reserves. But I think at the margin that's true, and what she said is also true, that it's doing the work of raising rate of what the Fed's doing with rate hikes, which is another reason, in my view, for them to pause and let this catch up, because we know monetary policy has a lagged effect. And we also know that M2 has gone negative. But this Fed has said that monetary supply has nothing to do with inflation. I think the facts prove otherwise, and that they should be looking at other indicators besides the few things that they are looking at.
So I want to get your thoughts on that. When you exactly think we'll see those tightening credit conditions really impact the banks, and how disinflationary will that be? Is it a 25? Is it a 50-point hike? What does it equate to, really?
It's very difficult to say exactly. It's very difficult to put a number on, translate the potential tightening that we haven't even seen yet into a number of 25 basis point hike equivalents, if you will. What I would say is, I think what we've seen here is that potentially we haven't really heard much from small regional banks yet. We know that the larger banks, as we had expected, have weathered this quite well, and some of them have actually seen an influx of deposits. And those are very valuable deposits in a high rate environment. Now, what we don't know is so far how badly regional bank lending has been hurt, in which areas specifically they may curtail lending the most. And can the larger banks that have weathered this well step in instead and provide credit to those areas if the smaller banks do pull back lending? All of those are still uncertain. We don't really have much data to tell us this, but this is what I would be watching out for if I were at the Fed, or if I was interested in exactly how much credit contraction we could expect. I would be watching for that substitution effect, potential substitution effect, if you will.
Yeah, Nancy, given all this, given the fact that you are confident that inflation is going to continue to tick down, how should investors be positioned at this point? Should they still be defensive, or is there this maybe time to add some risk into your portfolio?
So, Seana, we started adding risk back in the fall, and it seemed kind of crazy at the time. We were adding to consumer discretionary and to technology, and that's been a good place to be. Now, recently, we've started trimming because we've seen a really strong move in those names. I think you want to get through earnings season, use the volatility as your friend. If you're a long-term investor, volatility is your friend, and you should use it to pick off the high-quality names. I think the defensive trade is not necessarily over, but sort of fully valued. So you want to have some of that in your portfolio, but we've really been moving towards reliable growers, which tend to be the riskier names, and really strong management teams. I know that sounds like a cliche, but it really matters in this environment to navigate through. And so we have added to many of the names in technology and consumer discretionary, as I mentioned, and we've also added the metals and miners that drive planetary decarbonization, because we think we're in a commodity super cycle.
How does Tesla fit into that strategy?
I'm going to be buying after this report. Yeah, we bought some on January 3rd or 4th. It was just dumb luck. We pretty much almost bottom ticked it. And I think what I heard is different from what the street heard. This is a management team that is going to increase share, which is driving consumers into their ecosystem, which is what Apple has done. And then I think they'll reap the benefits for the long term. I think Elon Musk is so often underestimated. I've done it myself, but I'm going to be in buying.
Not concerned about those declining margins.
That are still double GMs and probably quadruple Fords.
Fair point,
yeah.
indeed. Nancy Tengler, Sonia Meskin, appreciate you both very much. Thank you.